sorts of long-term debt. What is it negative for? It's negative for mortgages. Mortgage rates have spiked on the back of the spike in the long-end bond yield. That's obviously negative for housing prices and for housing affordability. Part of the issue with these higher rates is that houses have been harder to buy because they're more expensive at the higher rates. More people have been renting. That's put pressure on rental rates. That's actually inflationary. That's a big part of the inflation calculation. It's also really negative for the US government, obviously, because the US government has to finance a massive deficit. As we've said, with bond yields higher, the US government typically finances its spending with a mix of short-term debt and long-term debt. They've been using a lot more short-term debt, as we've discussed in the past, because the rates on the long-term debt have been significantly higher than they have been. Our spending on just interest for our debt is getting out of control. This is really just bad for the consumer, and it's really bad for the federal government.